So today, as we sit here looking at what the market has done this past week, it's been an incredibly volatile week. It's the typical or traditional roller coaster ride that everybody says the markets go on, but more so this time. Why? Because 2 days this week we've experienced the two largest single drops in market history. On Monday, we had an 1,125 point drop on the Dow Jones. On Thursday, we had a 1,068 point drop on the Dow Jones. That's a heck of a lot of volatility. The next day, the market came back about 500 points. It's been up and down like a yo-yo, and it's gotten investors scared. It's given them cause for concern, and should they worry? What's the reason behind this? Well, there's a lot of reasons. Number one, the market's gone straight up pretty much for the last 9 years. Corrections are due to happen. But more importantly, and perhaps not as reported as should be, is one of the underlying facts about the market is interest rates are starting to rise. Interest rates, bonds, which work that way, and people who own bonds look at them as safe investments, which is really something that isn't true. The bond market's kind of been in a bull market, if you would, for the last 30 years. It's starting to show signs of age and showing them quickly. What's happening? Interest rates are finally starting to go up, more than just a token by the Federal Reserve. Federal Reserve chief, Federal Reserve members have all said they're not happy where interest rates are. They feel that the economy is recovering, and while the economy recovers, there is a reason to raise rates. And when the Federal Reserve raises rates historically, they don't do it just once or twice, they do it many times. And so you have a conundrum here. What's happening? Well, for the average investor, if they look at like the U.S. Treasury bill, the 10-year U.S. Treasury bill, it's down about 18% in the last 2 weeks. U.S. Treasury note. Treasury notes, 10-year maturity. Safest investment you could buy, U.S. government guaranteed. However, that's starting to show signs of what's happening with the market, showing signs of interest rates going up. The average investor who probably bought that bond yielding about 2.75%, he's probably about 18% down now. And if interest rates go up any higher, just kind of to recent levels of where they were prior to this, crash in 2008, 2009, you could see as much a drop as 42% on bonds. That's scary. And what's even worse is most people who've allocated their money as they get close to retirement, what's happening is they allocate 60% of their money to equities, 40% to bonds. And then as they get to that couple of years before they're about to retire, they make that flip over. They go 60% bonds, 40% stocks. And what's happening is because of these target date funds, whether it be for 2018, 19, 20, 20, 25, the closer you get to retirement, the more heavily they are weighted in bonds, bond funds, and yields, which can get destroyed in a period of rising rates. The first thing that we have is, that investors have, is this myth that you can't lose money in bonds. Yes, you can. And it happens every time interest rates go up, bond prices go down. Pretty simple fact. But if you buy a bond, and this is the difference between a bond and a bond fund, or a bond ETF, if you would. When you buy a bond, you have a finite maturity. You know exactly when that maturity is going to happen, whether it be in 5 years, in 7 years, in 30 years. You know exactly when that's going to happen. And if you hold it to maturity, you'll get your money back if the corporation's still in business. In all likelihood, if you own a government bond, you're going to get your money back. The government will pay those bonds off. But when you buy a bond fund, you buy a bond ETF, there is no maturity. They're buying a portfolio of bonds that could go anywhere from 1 year to 50 years, some even 100 years. And what we've seen, and what scares me more than anything else, the market has had a great move. And if you take out Facebook, you take out Microsoft, Apple, Google, Amazon, those 5 stocks have really led the Dow. But they also are in most of these ETFs or in bond funds as well, where they're using that to give you some additional growth. And if you take those out, and if you have a real problem with interest rates, you're going to lose a lot of money. Be very, very careful. Talk to us about bonds. Talk to us about bond funds. Let us show you some better and safer alternatives.